Hi, everyone. Welcome to the Friday's episode of Shiba's Money Show, where I share with strong-driven women how to live in abundance and retire with grace. Big disclaimer in the beginning, this Facebook Live and anything I share is for educational purposes only, and it is not to be construed as legal or investment advice. Any recommendations or conversations that we have about any investments, again, are just for you to know. If you have any personal needs and you would like to take action on any of those recommendations, please do reach out because they need to be right for you and what you're trying to accomplish for your personal goals. So with that, let's get started. What I will be covering this week and in the next 10 weeks is passive income, sources of passive income, what I consider those sources, and what I think their benefits are, their pros and cons, and what you would need, what you would do with each passive source to reach a passive source of income to reach your goals. Before we dive into these sources of income, what I want to do is just talk a little bit about sort of what is this idea of passive income and what I consider some of it as the misnomers and misunderstandings, perhaps. When we think about passive income, we think of something that perhaps is, what you sit on your couch and the checks keep coming in, or something that you don't have to work for. So passive income frees up your time to do things that you enjoy. And that is to a large extent is true, except here's the thing: anytime that your income source has any risk or uncertainty, it's inevitable that you have to spend time, energy, effort, and resources to deal with that uncertainty, to manage it, to mitigate it, to make sure that in the end that this particular investment does provide you the passive income that you expect. When I think about, active income, you're working for corporate America, you have your business, you spend a lot of time in your business, versus passive income where you are an investor. Either way, there is an amount of time and energy that you need to put into this effort. So to me, it's what is it that you enjoy doing more versus the choice between, hey, I work, so I do a lot, and hey, I have passive income, so I don't have to work. With that, I would like to focus today on sort of the easiest and most straightforward source of passive income for me personally, which is the interest and the dividends that come from investing in the stock and the bond market. So there are three types of passive income that I would like to cover today. They are CDs, bonds, and dividends from stocks. So why do I? So I have said I'm going to cover these securities in the increasing level of sort of complexity and the features, and also again uncertainty, because nothing that has nothing that's exposed out there to the markets in the world is really certain 100%. So with that, let's focus on CDs. What are CDs? So CDs are the certificates of deposit. And basically what it means is that you take an amount of money. We're going to talk about today about $100,000 that you have that you have in the bank, and you're sitting there thinking, you know what, I should make more money on this money. So you take $100,000, you invest it, you give it to an institution, to a bank, or as we will see in a second, to a company like Fidelity, and in return, they give you back interest. The reason that CDs are an awesome way to earn passive income is that once you invest in CDs, you don't really have to do much other than just receive this receive the interest and mostly hold them to maturity, because if you invest in bank CDs, if you take the CDs out before maturity, you actually have a penalty, so you don't see completely the interest that you were entitled to. What are CDs usually useful for. They provide stable income. It's not a lot, except in the environment of rising rates, which we are in right now. And it's a good way to leverage your money to make a little more interest in situations where you may need this money in 3 months, 6 months, 9 months, or 12 months. So related to that, what I would like to share is something that's called a CD ladder, which is a type of an investment that allows you that flexibility and also allows you to make a little more interest than your bank CDs would give you. So I'm going to share my screen and I'm going to show you what these CDs are. So basically what a CD ladder is a series of CDs of different maturities. Then you can invest it at the same time and earn more interest over time. So as you can see, the Fidelity here, Fidelity has excellent CD ladders that I highly recommend that you should look into if it's something that you're interested in. But as you can see, these CDs go by months and years. So you can invest in the 3-month CD, 6-month CD, 9-month CD, 12-month CD, up to 5-year CD. And what you can see is that a 3-month CD is earning you over 5% of interest these days, which is excellent return on your money, especially with the stock market being a little down and the real estate market perhaps having some higher costs. In situation where earning current interest is important to you, these CD ladders are a good opportunity to do so. So the way you would invest in these CDs, you would put $100,000 and you would divide them into either a CD, either 4 CDs or 6 CDs. And then you would put them on something that's called auto roll, which your 3-month CD would expire in 3 months, and then you would roll it into say your 1-year CD. And then in another 3 months, your 6-month CD would expire, and you would roll it into that 12-month CD, understanding that in general, with time, you earn more interest. So in general, 3-month CDs earn less than 2-year CDs because there is more uncertainty. Again, that feeling of lack of control and lack of knowing what's going to happen. So as an investor, you want to be compensated more as time goes by. Here you can see that it's actually reversed because interestingly enough, the 3-month CD and the 18-month CD pay about the same, but the 5-year CD pays less. And you know what this reflects? It reflects the current economic situation and the fact that there is a lot of worry about what's going on now versus maybe 5 years into the future. So again, if you're thinking about, one way I typically recommend having CDs is if you're close to retirement and you want to make sure that at any point in time you will have enough cash to cover your expenses, so that if the markets are down, you are not in the risk of not being able to pay your bills. So in a nutshell, this is what you do with CDs. And so CDs, good interest, flexibility. What I forgot to say, when you go to Fidelity and you invest in CDs, you actually don't have to hold them until maturity. You can actually take them out before maturity. You just sell them just like you would sell any other stock. So one thing about taxation, when you get interest from CDs, it's taxed with your ordinary income. Just like most investments, whether it is a stock or bond investment or even a rental income, in the end, it comes to your personal tax return and your personal tax rate. So that's CDs. As we move from CDs, another way to earn interest is bonds. So what are bonds? Bonds are basically a way for governments and companies, corporations, to borrow money for their needs. So for example, for the government, whether it's treasuries or municipal bonds, different types of governments borrow money so that they can pay their employees, so that they can do projects like bridges and building schools. And companies would borrow money so that they can invest in earning more income and more revenue down the road. And in return for you to giving up your money, they pay you interest. They pay you extra interest so that you are happy with the fact that you have invested your money. Most bonds pay semi-annual interest. So for example, if you invest in a bond and the bond pays a 6% interest a year, you will get in 3 months, in 6 months, you will get 3% of your, or 3% interest, and then in another 6 months, you will get the rest of your money. So again, it's a pretty passive way to invest. You basically put your money in, you do your upfront research, you figure out that the type of a bond that you're investing in is the right one for you. And then once you're invested, you don't have to do much other than collect checks. Except that, again, bonds are subject to interest rate volatility. So if there are changes in the interest rates, the value of the bonds drops, and if you need to cash them out, and then you have to be worried about when you sell them, when you sell those bonds. As you look at the bonds, it's the same picture. The bonds typically have maturities that are short-term, medium-term, and long-term. So you can buy bonds that expire, mature in a year. You can buy bonds that mature in 5 years, and then you can buy bonds that mature in 30 years. Also, as a sort of a bond investor, you can invest in mortgages, which mature in 30 years. So there are these things called mortgage-backed securities, where a pool of mortgages, people, when they have mortgages, there are companies that buy those mortgages and then they sell them to you as investors. So you get the interest as the homeowners pay their interest to their mortgages, it's distributed to you because you have helped people obtain those mortgages as an investor. So that's one thing, the maturity of the bond matters a lot. The second thing that matters is the credit risk of the bond issuer, whether they are creditworthy or not. So the treasuries, the US treasuries for now are absolutely, you don't have a risk that they will not repay, that they will flee somewhere, right? The government isn't going anywhere anytime soon. So those are less risky than some small company that is investing heavily with less certainty as to whether they will actually recoup the investments and have the profits to pay you back. So those are a couple of the ways that bonds differ. But if you're looking for a safer investment, not completely safe, but something safer that doesn't have as much volatility as maybe the stocks, to make sure that your portfolio, especially if you're close to retirement, doesn't go up and down quite as much, you would invest in bonds. So in any portfolios, you want to have a little bit of CDs to cover your 1 or 2 years of your expenses. If you're retiring, then bonds to make sure that you have a little bit of income coming in and you have a stability of your portfolio. And then last but not least, so we're going to talk about stock dividends. So what are stock dividends? Stock dividends is basically a way for companies to return money to their stockholders as a reward for being investors. Companies pay dividends out of their profits. If a company makes enough profit to cover their expenses, to cover their projects that they have outlined, that like the management, the leadership wants to grow the company, so they have specific types of projects that they want to do, then if there is money left over, then they distribute this money out to their shareholders in the way of dividends. So there are different types of dividends that companies pay. Most of them come quarterly. Again, what you do to gain dividends, first you invest in a stock, you hold a stock, and then as long as you hold the stock, you get the dividend, which you can reinvest and buy more stock, or just take it as income and live on it and use it as part of your passive income strategy. So what companies pay stock dividends? Not all companies pay stock dividends, right? If it's a newer company, it's growing, it needs to, the company needs the money and the profits to reinvest in the company so that they can continue to grow. They're not as apt, they're not as willing to pay out the dividends because then they don't have money to grow. So that in the case that you're investing in that stock, you're basically investing to grow your portfolio and the stock price versus take income out. So if you're a passive income investor, you would not invest in smaller companies that don't really pay dividends. But there are some, if you think about it, who has extra cash to pay dividends? What type of companies have that steady cash flow that's more than they need so that they can distribute it? Traditionally, those have been utilities, communications companies, oil companies, right? So the revenue keeps coming in, and especially with utilities, right? There isn't much that they obviously they innovate and they grow, but maybe not as much as some small like a electrical vehicle company that is investing and still trying to figure out how to make money. So you would look, if you're a stock investor that who is looking for a dividend, you would look for companies that provide high yield. And here I'd like to share with you a couple of opportunities out there that you would want to look at to start exploring and researching the types of stocks that would pay you a high dividend. As anything else, as an individual investor who wants to make the most out of their money, but may not be considering themselves a professional or not have the time to do all the research yourself, you would buy either a mutual fund or an ETF that would do the heavy lifting for you. So you will be basically hiring professional money managers who will look up the stocks, who will figure out which stocks are these high dividend paying stocks, and then they will invest in this company and give you the opportunity to invest in their portfolio and gain the same benefits and the same income that you'd like for yourself. The best way that I recommend looking for mutual funds and investments is going to Morningstar.com. It's a great research company and their recommendations are pretty solid. So as an investor, I typically start with Vanguard because Vanguard typically will have solid investments at a lower cost than most other companies. So one example that you would start with is see how it says Vanguard High Dividend Yield ETF. In this case, you would know that this ETF invests in companies that earn high interest. So you would go and start with a quote and see what kind of an interest would you expect from this company in 1 year? And you would see that this company's yield is about 3%. So if you invest $100,000, you will get 30,000. You will expect to get $3,000 of dividends in 1 year from this type of an ETF. So you can absolutely go and explore and see how and make an investment if it meets your needs in this ETF. And then you can also absolutely do your research, say, okay, maybe I like this, maybe I not, what else is available? So if you go to the performance tab in Morningstar right here up top, and you scroll down all the way down, you can see other categories. You can see category medalist. So Morningstar assigns these medals to indicate the quality of this manager or the quality of the process that a company follows. But usually the winners usually come up top. So it's an easy way for you to identify some good investments that Morningstar considers equivalent to the one that you're looking at, and also of comparable quality. So in this case, you could look at Fidelity High Dividend ETF and see what you would like to compare and how these two investments compare. So off the bat, one thing I would like to mention on these investments is that the Fidelity High Dividend Yield expense ratio, which means that the fee that you pay to the manager is about 0.29, a third of 1%. Versus if you go to Fidelity's, to Vanguard's ETF, and you look at their expense ratio, you can see it's like 0.06%. So it's a huge jump in fees typically from Vanguard to any other, pretty much to any other manager, which makes Vanguard investments typically a lot more cost effective. So you would really just see if this is something that you would invest in. Or obviously you can talk to your financial advisor or a planner who can look at your portfolio and know that based on your passive income needs, what would be the investments that would be suitable for your plan and would be suitable for your investment needs and for your time horizon. Again, so anytime you talk about investing, anytime you talk about income, it has to be your goals. And then based on that, you identify the sources of income to satisfy those goals. You want to have at least 3 or 4 sources of income. There's definitely 10 is ideal. But again, you need to be comfortable with the investment, understand the investments, and then make sure that you get those, make sure that you can spend the time and the effort required to manage your investments and get passive income from it. So I hope this was helpful. This video will be recorded. I'm posting it to Facebook, to Queenvest channel. If you're interested, do subscribe, because there is a lot of information and lessons that I post regularly. You can join the She Boss Money Show group if you find this kind of information useful and it meets your goals. And absolutely, last but not least, do reach out. I'm always available for a complimentary conversation, initial conversation, just to get to know you and your goals. So there is a link in the She Boss Money Show to my website. Go check it out if it's something that you'd like to explore, how to maximize your passive income needs. Reach out and we can have a conversation and see which type of passive income is right for you and how we make sure that you have that passive income and you spend your time the way you want to, and you live your best life and you live in abundance and retire with grace.